Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone. Welcome back to another episode of On the Margin. Today, I am joined by repeat guest Charles Edwards, who is the founder at Capriole Investments. Charles, welcome back to the show.
It's great to be here. Thanks for having us, Michael.
Yeah. So I want to get started. I've got your most recent investment note pulled up here, and I love it because I think it encompasses a lot of things that we talk about on the show. You've called it the 3-factor model. And I love it. The title here is What Drives Equities Markets, Fair Value, and Price Inflation. And you've named these 3 factors. So can you just kind of outline to us what these 3 factors are, why you've chosen them, and then we can sort of dig into the diaspora of consequences that result from it?
Yeah, no problem. Yeah, so that 3-factor model, I released that, it's probably 2 or 3 or 4 weeks ago, around there. But I was just trying to think of what is the most simplistic model for valuation, or what has the least inputs and explains most of the valuation in equities markets in particular. I basically just went for a walk one day and was thinking about it and thought of these 3, GDP, money supply, and interest rates. And those 3 in particular because GDP captures obviously innovation, technology enhancements, things that increase people's output. Money supply, as that goes up and down, that obviously impacts inflation and the overall price of assets, as we've especially seen in the last couple of years. And then interest rates, of course, the more aggressive they are, the harder it is to acquire capital, raise capital, and that is kind of an expense or a restrictor on growth, so to speak. So this model is simply just the summation of those 3 metrics and their returns on a daily basis. That's it. So GDP plus money supply less interest rates, and there's no coefficients or anything. It's just simply rate of returns of those added together. And if you put that on, baseline it on the S&P 500 at the starting point of that data set, which is 1965, it basically plots almost perfectly a linear regression on a log scale on the S&P 500, and it puts us today at almost smack bang fair value, just below actually. So that's quite interesting. I like that model because it's simple, and it explains 90% of returns over that 50 plus year period. So today we're actually just undervalued according to that metric. Of course, it's important to consider that there's lots of things that aren't in this metric. It's not looking at individual companies, and there's a wide spectrum of valuation and pricing there across equities. But it gives you a good reading of where we're at in the market, and how much hype or fear or pessimism is in the market. We're not extremely overvalued right now across the board. We're not extremely undervalued. It's pretty fairly priced. So if you scroll down on that, there's a version of that metric. So that's just the same thing on a log scale. It's a bit easier to see. And then this has just got a bit of a band around it to give you an idea of where we're at. And we plot those metrics live on capriole.com/charts as well.
One thing that I'm curious about is, obviously, if you rewind the clock back to the last couple of years, there's been an extremely tight connection in between, especially liquidity conditions within macro and the price of Bitcoin. And we got our decorrelation. It was the decorrelation that we hoped for, right? In crypto. But now what I'm wondering is, we've got slightly higher rates as sort of a base. We may or may not be at the end of the Fed's tightening regime here, but does that almost one-to-one correlation in between liquidity conditions, the NASDAQ, all that stuff still exist with crypto and Bitcoin? Or do we have the chance to be a little bit more idiosyncratic here, and there could be a break to the upside that's independent of macro?
Yeah, sure. So I think, short answer, definitely we do. And a part of that is the extremes that Bitcoin's been at. When you're at this kind of cyclical lows, 80% drawdowns have happened, the decorrelations tend to to play out across markets. So, and we saw that this year with Bitcoin leading on the risk asset side and completely rallying substantially. So, short answer, it shouldn't matter too much. But the longer answer is how would it play into it? And I think that, of course, it will have an impact. There will be relationship between the two, especially if the Fed pivots or if they have to print excess liquidity into a new crisis, which may or may not occur in the near horizon. So we've covered off a number of the macro elements. Valuation-wise, it looks relatively normalized, but across a number of other metrics, some concerning factors to monitor. And things could move quickly. If unemployment ticks up or if consumer spending does collapse and continue the trend it's on right now, then knowing that consumers are out of that excess savings they've had from Corona and knowing where the stresses are in the banking sector, there's definitely factors there the Fed's going to be watching. And they've been building this war chest to cater to that by the reduction in their balance sheet and by the interest rate rises. So they'll be ready for the next crisis when it happens. It's hard to say when that will be, but either way, what I'm trying to say here is that either way, when they have to step in, it's going to be great for inflation hedges like Bitcoin and gold, with 90% of that, probably that inflation hedge benefit going towards Bitcoin. And of course, with the halving coming up, that's really going to add some fire into Bitcoin.
I would love to get your sense of how you're viewing the halving. So if I had to drastically reduce the simplicity of the Bitcoin cycle, I'd say something to the effect of, right, there's an initial sort of level of demand. The halving ends up cutting supply in half. That supply shock sort of ripples through the market. The price starts to take off. It kicks off this extremely reflexive cycle. This is the price innovation cycle of crypto, right? The higher the price goes, the more media covers it. You get these weird buyers and these narratives of like treasuries putting Bitcoin on their balance sheet. You get the Sailors of the world. All these buyers sort of come out of the woodwork. El Salvador adopts it. Very unpredictable stuff. And then at some point, the price starts to collapse under its own weight. Nothing can go up in a parabolic line forever. For whatever reason, price starts to turn over. Bitcoin passes from weaker hands into stronger hands. And then typically marking the end of the capitulation is when miners start to sell, because when Bitcoin has been going up, people view it as being very attractive. It's much more profitable to mine. We don't need to get into the whole cloud mining model, but that was something that was sort of doomed, where people lock themselves into these heavy sort of capex cost structures, and then they get a bunch of little miners that put their mining equipment in that factory. Then they want to turn it off, but then these people are stuck with these rigs. So it just creates this forced selling dynamic. The Bitcoin disperses, the level is found again, the bottom is sort of found, and then we rinse, wash, and repeat. The thing that is a little bit different this time, right, is every cycle, Bitcoin is a slightly lower amount of the overall crypto market cap. And one big change, I think, this particular cycle is stable coins as well. And a lot of folks that fled into Bitcoin in previous cycles are now holding stables. And my question to you is the halving still going to be this big supply shock thing that kicks off the market cycle like it has been in the past? Do you see its prevalence being overall sort of diminished, or how are you just viewing the halving as a catalyst?
Yeah, no, that was a great summary of Bitcoin in the last 10 years or so. So I agree with everything you said. And yeah, so short answer is, I think, this cycle's still playing out to effect. And we've seen continued evidence of that just over the last year. So Q4 2022, obviously we had the collapse of FTX, the market bottom at 16K or so. And that is cyclically wise, almost smack bang within a few weeks of every prior cycle bottom. That's one data point. But then there's lots of other data points on the on-chain side, which not just timing wise, but also valuation wise, are very indicative of where to expect to be 6 to 9 months out of that sort of vertical price action part of the Bitcoin cycle, which typically follows the halving event, as you touched on. So yeah, this next halving, obviously, we're talked on is going to be very powerful in terms of the narrative kick, becoming harder than gold, the best inflation hedge asset, obviously, in the world now. So Bitcoin's really going to have that under its belt. Whether or not stablecoins have an impact, I don't think so. I think Bitcoin still leads the pack in terms of the crypto market. There's been plenty of consideration over the last 2 or 3 years if the cycles were over and everything's priced in and we're a bigger asset class, and that hasn't played out yet. I think, in hindsight, if we didn't have the most aggressive macro policy being implemented at the same time, and if we didn't have all these bad players in the industry that have been washed out, maybe things would have been a bit different, but we still would have had quite a significant cyclical impact. So we still get these 80% drawdowns. Altcoins were destroyed, down 90% in complete capitulation now. So things are really just ticking along with how you'd expect a cycle to be. So yeah, I'm definitely expecting a lot of those elements you talked about to play out next year. The kind of self-fulfilling nature of it and how the markets go up in accordance. There'll be a supply squeeze at the same time. We've got these ETF approvals, which will very likely be rolled out at the same time. Biggest asset manager in the world, BlackRock, obviously expected to be approved the next 6 months or so. Overnight, we've had, or during the day for you guys, we've had the Grayscale SEC ruling overruled. So all these things are kind of lining up for heavy capital flows to come in, and everything's matching what you'd expect to see in the data.
Hey everyone, we'll get back to the show in a minute, but just wanted to let you know that we've got our permissionless conference coming up. This is the one that we do with Bankless. It is the biggest and best conference in DeFi. It's going to be in Austin, Texas this year, September 11th through the 13th. Now, you've heard me say this many times on our show before, but the time to be bearish on crypto was 18 months ago when the Fed began raising rates. Since then, our entire market is down more than 50%. We've had all this bad news. In the last 2 weeks, we had BlackRock and a whole slew of other institutional investors file for a Bitcoin ETF. This space is not going anywhere. So if you're interested in investing in the space at all, I highly recommend that you attend this conference. The other thing, and I've said this before as well, bear market conferences are the best ones. In the bull market, you have all this retail, all this noise. Now you only have the people that are really here building great products. This one is worth your time 100%. And since you are such good listeners to On Margin, which I really appreciate, giving you all a special 30% discount code. It is MARGIN30. Now you can access that by clicking the link in the bottom of the show notes. So you can see my fingers pointing down, click that link. Because you are a listener of On the Margin, you get 30% off to the conference. Again, the code is MARGIN30. We'll see y'all there. Just to underscore that, this just came out today, but the U.S. Court of Appeals granted Grayscale's petition for review on, so we're recording this on Tuesday. It happened again during our day, where, to drastically oversimplify, Grayscale has indicated its desire to transition from a closed-end fund into an ETF, which was originally shut down by the SEC. That has gone through the Court of Appeals, and what the court essentially came back to Grayscale, to the SEC, and said, "We don't follow your logic here in denying this ETF application. So you need to go back. You need to go and take a look at this." So on the head, that doesn't sound so great. But the actual logic, right, is when you start to dig into what the court questioned and didn't exactly stand up one-to-one is, well, they pointed out, I think, what many of us in this space have thought for a long time, which is it makes zero sense that you would have a futures ETF and not a spot ETF, because obviously the spot and the futures are correlated. Seems like a pretty simple transitive property logic, right?
Logical, yeah.
Seems very logical. So I'm not a legal expert here. I do think, people tend to rush to conclusions, but it definitely is not looking as slam dunk as it did for the SEC in the past. And I also think, look, BlackRock would not, they have a 575-1 record of getting ETFs approved. I just don't think they would have done this to make a political statement. And so to knit all of this together, I think it looks like we might be getting, knock on wood, a potentially a Bitcoin ETF approval around, within 2 months of the halving cycle. And that would roughly align to when the market is pricing in the first rate cuts for the Fed.
Exactly. And yeah, the SEC's credibility just being destroyed, isn't it, at the moment? It's unbelievable it's taken this long, but it's great to see that this is progressing in the right way now. And I think that was, like I said, is pretty much guaranteed as soon as BlackRock entered the picture. They've got 99.8 success rate for all ETFs. So it's almost a certainty. It's just a matter of when. And if you look at the Grayscale Bitcoin trust discount to the spot market. That's also been a pretty good sentiment metric of how things have improved this year. So it went from minus 50%, so 50% less value than the the Bitcoin price, to about 25% a couple of days ago. Some substantial improvement, which means there's probably some institutional capital flows happening there throughout the year, and then that's now jumped to minus 17 with this news in the last few hours. So almost at the spot market price, which is a great barometer for spot market sentiment. So there's been a number of things like that improving this year. Despite it being feeling slow in the space, even though price has gone up a lot, we're at all-time highs in hodler rates. So 2-year holdings plus have reached 56%, which is huge. So half the network isn't moving their coins at all. We've also just had an increase in adoption. So new high, approaching the highs of wallets with just balance on it.
It's very easy to make the mistake of assuming that the next 12 months is going to be similar to the last 12 months. And I think there's pretty good evidence to suggest that that's not going to be the case. And it's very tempting to believe that right in the nadir of a crypto winter, right? It's hard to see the light at the end of the tunnel, but I think you're getting some forward-looking indication that things might change, right? And just in terms of cycle lengths, this is about we're approaching, I think, one of the longer bear markets that crypto has ever been in. So unless you think that it's not going to turn around, now is probably around the time to start taking a look, right? You're starting to get those initial bits of, hey, maybe that we might turn the corner here soon.
The metrics that I look at to confirm timing wise where we might be in the cycle is the relative. You want to see extremes hit and undervaluation hit in a lot of on-chain fundamentals, and then they should come to a normalized level. And a lot of important long-term metrics have hit that sort of mid-range level, which matches pretty much exactly like 2019, 2015, 16 sort of range, where you get the bottom part of the cycle and things start to tick up. So we've had a long-term holder inflation rate, which is kind of the growth rate in long-term holders, exactly hit that normalization. Supply delta, another metric of the sort of short-term to long-term hodlers and how that's trending, also normalized. So things are shaping up quite well for, I'm kind of thinking 2024 will be that single sort of 12-month window where you get 90% of the returns in each Bitcoin cycle. So Bitcoin's so asymmetric. You sit around for 2 to 3 years and go through a lot of pain. And then you get about 12, if you're lucky, 18 months of incredible returns. And for me, that window's rapidly approaching in sort of the 2024 time space.
So can you describe, we're looking for listeners who are following along on audio, we're looking at the HODL growth rate chart that Capriol, Charles have put together. So what we're looking at here is a Bitcoin price going back to 2013, assuming that this is in a log scale. And we're also looking at this metric that you gave us, which is the hodler growth rate. So I would assume, is this the percentage of people who've been holding for a certain period of time, or what is this? What is this measure?
Yeah, it's essentially the annualized growth rate or rate of return. So the change in the long-term hodlers. So those that have held their supply for over 2 years. So if you've got conviction asset class, you're going to hold it for a long time, and that drains supply from exchanges. It drains supply from new entrants and other adopters, which obviously is the same as a halving event, right? It creates a bit of a supply squeeze, or a price has to move up essentially if more and more people are holding long term. So that is, as I said, that metric alone, just the raw 2-year plus holding, has hit a new all-time high. But if you just annualize that in the growth rate, is what this chart is here, you can get a bit of a picture of how that changes through the cycles. And normally that, what we called here the hodler growth rate, would peak at the cycle lows because the long-term investors maximize their holdings at a discount, and then they look to sell and reduce their holdings as price rallies up. So they're locking in that profit. So we've hit a level now in end of August 2023 where we've had exceptional growth through the year, and it's now starting to plateau in a similar structure to what we've seen in every prior cycle. And every prior cycle, obviously, the relative heights diminish as we have less and less new supply hitting the market, and growth rates organically just on all assets decay over time. So it's very much syncing up, as you can see with the limited data points we have there, with where you would be at the end of a bear market and 6 to 9 months out of that real price opportunity coming. It is worth noting though that this, like a lot of these kind of cyclical metrics, suggests that we could still have 3 to 6 months of consolidation ahead of us, or sort of choppy, uninteresting price action. But that's basically the last window of opportunity you have, historically at least, to kind of make long-term allocations at great prices.
One of the other trends that you see in Bitcoin over time, and I'm going to go out on a limb and make the argument that this is actually a good thing, because I think what we want is for Bitcoin to be seen as a store of value and money. And what you need in order for that to be the case is less volatility over time. So if you look at the percent returns of bull markets going back from 2013, 2017, 2018, the most recent one, the actual trough to peak returns of Bitcoin diminishes over time, which people like to say, hey, the returns are going down over time. I personally don't think that's a bad thing. If what we want is for Bitcoin to be a store of value that big institutions all over the world are going to hold, I would argue that reduction in volatility is actually not a bad thing for the long-term returns of something like Bitcoin. But how do you expect that playing out this next cycle? Should we expect diminished returns, sort of peak to trough compared to what we saw last cycle, or how do you sort of model that out or think that through?
Yeah, in the long term, Bitcoin will be a very boring asset. I think if you fast forward 10 years, maybe 12, 2 or 3 cycles, I think the volatility is going to be very dampened and just trend down ultimately in the long term to essentially what you might think of as a stable coin. Because everything's known in advance. The supply growth rate's known in advance. And at some point, the incremental drops in that supply growth rate, or from the halving, is just going to be so negligible, it doesn't matter. So I think the cycle's still relevant, but every cycle diminishes in size. And that chart also we just had up shows that as well. Just looking at the hodler rates, everything is always diminishing. But that's normal in any asset class that goes from small to big. Any stock, any investment experiences extreme volatility in its sort of startup growth phase, lots of up and downs, and then it ultimately stabilizes significantly over the coming decades. So there's no reason to not expect that for Bitcoin as well. But we're still a while away from that.
Yeah, the flip side of that is the larger and more liquid that the Bitcoin market becomes, you level up into new buyers. So one of the complaints that you used to hear, especially around 2018, 2019, and it's coming back now because there's a lot less liquidity in crypto overall, but even Bitcoin, is, look, if there are sovereign wealth funds over in Europe, the Norwegian sovereign wealth fund has $1 trillion. I mean, Bitcoin is simply too small as an asset class for this to move the needle for their portfolio. But the larger that you get, the more you level yourself up into these buyers that have much deeper pockets, and you can continue to propel Bitcoin's growth into the future. So that's another framework that I've always had in terms of Bitcoin unlocking new.
Yeah, that's definitely true. And then you get to the government level as well. So it's not going to be just a straight path of down volatility. There's going to be spikes in there, possibly bigger than we've ever had before. It's just if you really zoom out over decades, I think that the trend will be a continuation down, but with a lot of swings in there, especially in the next 1 to 2 cycles. We could see potentially some of the biggest volatility and upside returns we've ever had, because we're kind of hitting that S-curve part of the adoption cycle where you start to go vertical. You have about 10 years of kind of growth, and then you go vertical as it goes from early adopters to sort of middle of the market. The majority of people enter the space, and then it kind of plateaus again. So it's not a one-way line, but and I think there's tons of opportunity in the next decade. It's just beyond that. I would expect to see the impact of cycles start to reduce.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. One thing I'd love to get your perspective on as well. Here, let me actually pull up this chart, but there was on one of our other podcasts, 1000X, there was the Avi Fellman and Jonah Van Borg made this observation about it's kind of a point people used to bring up about macro proxies for institutional demand in Bitcoin. And what they observed was that before the sell-off a couple of weeks ago, you actually saw MicroStrategy and Coinbase, which in a sense, I think are probably indicators of demand, public market demand in Bitcoin. You saw it kind of leading the way here, right? So these orange and green lines sort of led the way down, and then there was this sell-off in Bitcoin. I would be curious. I think it's relevant for investors listening out there who might think to themselves, Bitcoin feels a little risky, but maybe these public market stocks like Bitcoin miners that actually produce cash flows, this feels more real and substantive to me. Do you think that that's ultimately less risky, or how do you view the relative investment of some of the public market opportunities for exposure that you have for Bitcoin versus just owning spot?
So that must be BlackRock pushing the prices down, yeah? No, I think, yeah, exactly. I think that's probably, those assets, stocks effectively being used as a proxy for Bitcoin. I've spoken to a number of, anecdotally institutions in range of size over the last 12 months. And since FTX, there's been a lot of hesitancy to get into this market. There's also been some, professional trading firms from TradFi markets that had started to dabble or set up pilot projects, if you will, in crypto in 21 and even early 2022 that just pulled the plug and exited. So I could imagine that that teams that had already set up capability or saw different opportunities would be more willing to trade that stock at least on a short-term basis if they're not comfortable with custody options, etc., that exist in crypto. I do think that story is changing now. As I said, we've seen a lot of recovery in 2023. We're seeing all the regulation go the right way. Even just this Grayscale thing the last day, normalcy and logic is starting to take place. So things are changing, but I think once we get those major ETF approvals with BlackRock and the various other institutions, Fidelity, etc., that are following suit, we'll see flows probably of institutions, head towards Bitcoin more. This sort of anomaly or delta will close a bit. But yeah, we're just in this weird spot where we kind of stepped back. We went through such great sort of institutionalization in 2020 and early 2021. And then we took about a 3 or 4 year step backwards in the last 12, 18 months. And I think that will again revert in the next sort of 6 or 9. But we definitely took a bit of a step back as an industry in 2022.
I've always had mixed feelings about that as an industry participant because on the one hand, it sucks, right? And these periods of time aren't fun because all the growth that you were experiencing during a bull market reverses with gusto in the opposite direction. Some of the new entrants that you might have been subconsciously hanging your hat on for credibility and say, oh, well, like this big institution might have been buying, or this media outlet is covering, or this, that, and the other thing start to go away. But the flip side of that is if you're a long-term investor or an operator in this space, it is long-term good for your relative market share because these people that didn't have real buy-in or conviction or a thesis about the space were about to come in and throw ungodly amounts of money at the sector that you're operating in. Hard to compete against ungodly amounts of money.
Mm.
And now this happens to us in media every couple of years, where the Wall Street Journal and Bloomberg say we're going to gear up and we're investing in crypto and we're building a team, and then this period of time happens and like we don't think we need to do that anymore. So
Yeah.
it's just a silver lining of working in this, where I don't want the institutions not to come in, but I always view this as a period of runway for us to have as well.
Yeah, I agree. You're right. Silver lining is a good way to put it. It's definitely an opportunity for us to stick around and go through the slog. I think, we touched on before the show that those that are left working full time in industry are the ones who, at this point, they're not going to leave. There's been some people come and go who are in for the hype, but it gives us a good opportunity at the moment.
Yeah. So I want to start to wind down here, Charles, and maybe call in a little bit with a little bit more specificity on some of your recent research. So I'm looking at a piece here that you guys put out, the Capriol Macro Index. This came from a couple of months ago, but you mentioned you were describing some of the metrics that you look at in order to get a sense of where we are in the cycle. And you list a couple of the inputs into this index, such as hash ribbons or supply delta, their Puel multiple, or any number of things. And you sort of define Bitcoin regimes. And I can share my screen as well, just give your research a bit of a plug, but also give a visual for the listeners who are following along, because I find it helpful as well. And wondering if you could just define what you mean by the macro index and these Bitcoin regimes, and then maybe help us place ourselves relative to the current cycle. And I'm going to ask you to dust off your old crystal ball and give us some predictions about how much longer we've got in the slog here.
Yeah, sure. So that looks like it's the article we wrote about that whole index. It's essentially a strategy which aggregates over 40 different on-chain fundamental data points and equities-based data points, and feeds it through an ML model, which basically weights all those parameters and rebalances and then adjusts on a daily basis to where we are on a regime, from contraction being fundamentals on-chain data essentially going down, to expansion where they're going up. And it's basically all an oscillator essentially around a zero line, kind of like a Z-score, if you will. So below zero, recovery is when you're trending up but you're below zero. Expansion is when you're above zero. So the darker the green on this chart here, the better. Typically the improvement in fundamentals, it's typical of the early stages of the bull run where you get the most gains as well, and vice versa for the red or the contraction. If you click on Insights as a charts page, so you can see there those colors are kind of overlaid on the price. And we went into contraction about 4 or 5 weeks ago, around 30 odd K, which basically is saying that the fundamentals looked pretty bad. They continue to trend down. And so that model, for example, would be in a cash position. And today, they're still not looking great. But something to note with this, this is not looking at price at all. It's only on-chain data. It's great for managing risk. So when it churns from recovery to contraction like it has here, that was a good signal to reduce allocation in the market. So something we write about a bit in our bi-weekly updates. But it's also a metric that can be slow to turn around. So if things, the fundamentals and price, they're interrelated. Sometimes one follows the other, sometimes the other way around. And if things move quickly or you get made, if BlackRock ETF gets approved tomorrow, it's going to take a while for on-chain data to catch up with what will probably ensue over the next sort of 24, 36 hours. But for now, this is the main sort of bearish factor that I'm monitoring closely for Bitcoin allocations. If this was trending up, I would, feel like it's an incredible opportunity right now. I think it already is a great opportunity in terms of the level of discount. So if you scroll down to the next chart, that's the sort of that gives you a better idea for value of how deep that reading of that scale is. So the depths of the bear market, the FTX collapse, for example, you get to around -2. Incredibly rare, and that's like those opportunities you just want to grab. Where we are now at sort of negative 0.5-ish, maybe negative 0.6, is typical of the late stages of a bear market. So you're not going to get much better than this. Like, I don't think we're going to get to -1. And we're rapidly approaching, as you can see in that next chart even. I'll finish up on that one. But we're rapidly approaching the red line there, which is Bitcoin's electrical costs. And that's the historic price floor for Bitcoin. So that, for me, that's the single best long-term sort of allocation metric you can use, because it's the absolute floor price of electricity that miners have to pay on a global average basis. As you can see, price almost never goes below that red line. If it does, it's for a matter of hours or days. So that's at 23K today. We're at 26 odd K right now, 27. And so that just tells you where the relative opportunity is. It's definitely skewed to the upside. I would, I'd love to see 24K taken and have an increased allocation, 24, 23K, 24 being weekly support, and then 23, this kind of floor level. That may not happen. And it just tells you that, okay, does it really matter as well in 1 or 2 years if you got it at 24, 25, or 26, if we're at this level of kind of opportunity here? So that's one metric to keep in mind. And amongst all things, this one probably provides a bit of clarity, for me at least, in where the value is.
The electricity as a price floor is just it's a very simple thing for me, at least me, to always understand why that should exist. And yes, I see in this chart that it does. And yeah, I also agree with, first of all, we'll link this in the show notes, but guys, highly recommend that you go and check out some of the resources that Capriole has. But I think this, just to maybe layer a little bit of subjective commentary on top of this chart, just foots with how I think about things as well. You had the FTX sell-off at one point last year, or in November of last year. You had pundits calling for the end of crypto. You had prices falling out of the sky, just capitulation and forced selling as far as the eye can see, bankruptcy, and you were just never going to do much better than that. I think that sentiment, obviously, this is not financial advice. I have no idea, but it does feel like you're not going to get a much better opportunity. You might get more time, but you might not get a much better opportunity than what exists today. Assuming that you're a buyer in this market and you're long Bitcoin and crypto overall. But
yeah, I'd agree with that. We're in this sort of time period where it seems like you almost have forever because we've been going through this for so long in this bear market phase. But it's one of those things that just ends overnight. You'll wake up one day and that opportunity will be gone forever. But of course, it's crypto. As we've seen in the last 18 months, anything can happen. Nothing's impossible. So you always need to manage your risk and be comfortable with the allocations you make.
Charles, you've been generous with your time here, and I just really appreciate you coming on and got this great synthesis of the high level macro, but also even getting down to some of the technical indicators of Bitcoin. Just feels very valuable to me. If folks want to find out more about you and your work, or follow the work that you do at Capriole, or whatever, what's the best way to follow, get in touch, find out more information, whatever it is?
Yeah, sure. And my pleasure. It's been great to be here and chat about the markets. Always enjoy that, Michael. So thank you. Yes, you can follow me on Twitter at Capriole.io, or X, I should say now, I guess. And obviously we've got our website, capriole.com, if you want to reach out.
I'm just not sure I can ever call it X, but yeah, technically it is X.
It doesn't feel right yet, does it?
This feels weird. It just doesn't flow.
It's going to take a while.
Yeah, I'm with you. All right, Charles, this has been a phenomenally fun conversation. I'm sure listeners will find it as useful as I did. And thanks again for coming on.
Likewise. Cheers.